So welcome to my Accounting 1120 discussion, continuing on the topic of corporations. My goal in this pencast is to learn how to split, learn how to split dividends and do the accounting for them between preferred stock and common stockholders. There's some things that we need to learn to get good at this. So the first thing we need to learn is some ideas associated with dates. There are 3 dates that we're particularly interested in our discussion of dividends. The first date is the date of declaration, the date the board of directors declares, the date of declaration, the date of record, and then finally, last but not least, definitely not least, the date of payment. So what happens is the board of directors meets and they declare a dividend, and on the day that they declare it, it becomes binding. It can't be undone. It's a legally enforceable contract because cash is involved. So the board of directors meet and they declare a declaration, and on that date we make a journal entry. Let's say it's May 1st. On May 1st, the board of directors meets and declares a dividend to be paid down the road. And they'd say, let's say it's a $10,000 dividend. So they would make a journal entry and they would debit retained earnings. You remember dividends come out of retained earnings. I think we said it was $10,000. And they credit dividends payable. What usually happens is the board of directors meet and they declare a dividend payable to stockholders of record about 2 weeks down the road to be paid about maybe a month down the road. So on May 1st, the board of directors would meet and declare a dividend in the amount of $10,000 to be paid to, say, stockholders of record of May 15th to be paid on May 30th. So on May 1st, you make an entry recording the liability. On May 15th, there is no journal entry required. It's the day you make a list of who owns the stock, because they get the dividend. So you're making a list, checking it twice. Okay, that's pretty funny because Christmas right now for me is about, I don't know, we're zoning in on it, 6 days away. So I'm making lists too. But our board of directors makes a list. They get the registrar of the stock to make a list on who's going to get it, payable May 30th. And on May 30th, that dividend is paid. So a journal entry is made because a check is cut and the dividends payable goes away, and so does the cash. So 3 dates are of importance. Board of directors meets and declares a dividend payable to stockholders of record somewhere in the future on a specific date. Those are the entries that come out of it. Notice the impact. This will become important shortly. That a dividend has on financial statements of a corporation. When it's all said and done, cash goes down and retained earnings goes down. Declaring dividends make you permanently smaller. So you have to be frugal on how you have it. You have to have retained earnings, a positive amount to pay a dividend. So we've got this date thing under control. Now we need to learn how to split the dividends between common and preferred, because preferred stock are going to get some and common stock are going to get some. But in order to do that, we need to learn a little bit more about preferred stock. So let's increase our discussion that we've had on preferred stock. When preferred stock's issued, it has a rate listed right on it, and it's a rate of dividend payment. It's usually around 6%. And it says rate of dividend, and we'll assume 6% in our example, and it's understood that that rate relates to the balance in the preferred stock account. It does not relate to the balance in the preferred stock or the contributed capital paid in excess of par for preferred stock. It just relates to the preferred stock. So let's have an example where we have preferred stock. And the par value of preferred stock on our balance sheets, $100,000, and we have some paid-in capital from this preferred stock. Let's say our paid-in capital is $50. If it's 6% preferred stock, you would know that the 6% relates to the balance in the preferred stock account, and that they would be entitled to the first $6,000 of dividends paid. So preferred stock has a rate, and it relates to the preferred stock account, and it puts them ahead of common stockholders. Preferred stock can also be one of two types. It can be cumulative, or it can be non-cumulative. If preferred stock is cumulative, that's a good thing if you're a preferred stockholder, because if the dividend is passed over by the board of directors, they don't have to declare one. Then you're going to get it, but you're going to get it later. You have to wait for it. It accumulates. It's not a liability until it's declared, but it's said to be dividends in arrears, and it will be kept track of, and you'll be paid that before common stockholders will be paid. If the stock is non-cumulative and it's passed, you can wait until, I won't say that. You can wait indefinitely. You're never going to get it. It's just passed. You'll never have that dividend. It's gone. So if you're a preferred stockholder, you like the cumulative feature. If you're a common stockholder, it's not your favorite. I think the best way to go from here is to give you some examples. As always, we need to start with facts. Here's our facts. Our balance sheet shows preferred stock has in it $100,000, and our common stock has in it $500,000. Furthermore, the preferred stock 6%, so now you know that means they're going to be paid a dividend in the amount of $6,000 ahead of common stockholders. And here's our little business's dividend history. We passed dividends in 2012 and 13. In 2014, the board of directors declared an $18,000 dividend, and in 2015, they declared a $30,000 dividend. Now, let's assume that this stock is non-cumulative, meaning if it doesn't get declared, it gets passed, and it's gone. And make a worksheet, much like we did for partnerships, to look at how to split this dividend. So we'll have a year column, and we'll have preferred stock getting some dividends and common stock getting some dividends. Then we'll have a total that we need to split up. And in our first case, our total is they passed in 2012. So our total is 0, and that's exactly what everyone got. A lump of coal. Ha! Christmas on the brain, huh? In 2013, bummer, passed again. No dividend, and that's exactly what anyone got. 2014, some more interesting. A dividend was declared in the amount of $18,000. Nice. First hit goes to preferred stock. They get their 6%. And that leaves $12,000 left to distribute. Now remember, this is non-cumulative, so common stockholders are going to get the whole $12,000, and that is how the dividend will be distributed. $6,000 to preferred stockholders and $12,000 to common stockholders, and that is the totals for 2014. How does 2015 shake out? Not a whole lot different. It's 2015. A $30,000 dividend was declared. I like my dollar signs to be there. And the first thing is the 6% goes to preferred stock. It's non-cumulative. That's all they get. That leaves $24,000 to give away. And the $24,000 will go to the common stock because they get whatever's left. Not earmarked for preferred stockholders. And we're through. And the preferred stockholders get $6,000, and the common stockholders get $24,000, and that's how it ends up for 2015. Notice, nothing for the preferred in 2012 or 13, $6,000 in 2014, $6,000 in 2015. That is the nature of payments if it's non-cumulative. How about we do this again, but do it with cumulative stock? Let me put you on hold and bring forward the dividend history. So here's our dividend history. 2012 is past, 2013 is past, 2014 is past, or 18,000, 2015 is 30, and this time we're going to do our example again, but this time it's going to be with a cumulative feature. And remember, we had $100,000 of preferred stock at 6%, so our dividend is equal to $6,000, and it was based on the balance in the preferred stock account. And the first thing we're going to do is make a little worksheet where we're going to look at preferred stock. We'll look at the year, we'll look at preferred stock, we'll look at common stock, and we'll keep our eye on the total. So in 2012, no dividend was declared, and no dividend was paid to preferred stock, and no dividend was paid to common stock. But in the balance sheet, it will note that there's dividends in arrears for this year in the amount of $6,000. There'd be a note in the financial statements that say dividends in arrears, $6,000. In the year 2013, the dividend is passed up by the board of directors again. No dividend is paid to anyone. And now there's a note that says we have $6,000 in arrears for 2012 and $6,000 in arrears for 2013. And it's not a liability because it hasn't been declared. It's just a note. 2014 is going to get more interesting now. In 2014, a dividend in the amount of $18,000 was declared. The first thing that will happen is dividend in arrears for 2012 will be cleared up, and the preferred stockholders will get $6,000, and that will drop the $18,000 down to $12,000. The second thing that's going to happen is the dividend in arrears for 2013 is going to be paid, and the preferred stockholders are going to get that, and it's going to leave $6,000 left. Now we need to get the current year for 2014 paid, and it will go to preferred stockholders first. Wow, it sucks to be a common stockholder. And the arrears are paid in full, and alas, so is the dividend, and all $18,000 is going to the preferred stockholders with a big fat lump of coal. for the common stockholders. If you're a common stockholder, you want to know if there's a cumulative feature on the preferred stock standing in front of you, wouldn't you say? Finally, 2015. We have a decent dividend paid, and it's another 2 in a row. That's helping things out. 30,000. 6% is going to go to the preferred stockholders because they get their first amount paid ahead of the common stockholders. That leaves 24,000 left. There's no more dividends in arrears, and the common stockholders are entitled to the residual amounts. The dividend is fully distributed, and 6,000 goes to the preferred stockholders, and 24,000 finally to the common stockholders. So what does the cumulative feature do? This was passed and this was passed, but because it was cumulative, it was in arrears, and the arrearage was paid oldest first, next oldest second, current third, and then we're back to just paying them on time. There are a lot of people that think the cumulative feature makes preferred stock that has it a lot like debt. You're going to get your 6% return either way. You just might have to wait a while for it. Oh, hopefully you liked this discussion on how to split income between common stockholders and preferred stockholders. And Merry Christmas to all, and to all a good night. Talk to you soon.